Have you ever heard someone say that they got marketplace health insurance, but then ended up owing money back at tax time? Maybe you've even been through it yourself. Or maybe you're on the other side of things and you've wondered if you've accidentally been overpaying because you estimated your income too high and missed out on savings that you could have qualified for. Well, the truth is, health insurance can be incredibly helpful and necessary, but there are a lot of rules out there that people just don't understand, especially when it comes to income estimates, dependents, tax households, and filing your taxes correctly. So, in today's video, we're going to do a deeper dive into how marketplace health insurance eligibility actually works, how to avoid some really common and costly mistakes, and how to maximize your savings the right way without creating problems later. As always, keep in mind that this is general education information and everybody's situation is different. So you'll want to consult with your tax advisor and agent in your state. So, why does marketplace income matter so much? Well, one of the biggest things people don't realize about how ACA marketplace health insurance is that your monthly premium savings are usually based on your estimated yearly household income. So, when you apply for coverage through the marketplace, you're not just picking a health insurance plan, you're also estimating what your household tax situation is expected to look like for the year. That estimate helps determine whether or not you may qualify for premium tax credits, also called subsidies. Those lower your monthly premium costs if you're eligible. And sometimes the savings can be substantial, but it's important to understand what actually is a tax household because it's not always just who you live with. And this is where sometimes things start to get confusing for many people. Marketplace eligibility is generally based on your tax household and not just who lives there physically. So, usually it will include the primary tax filer, their spouse, if married, and to qualify, they would have to file jointly, and then dependents that they claim on their tax return. And this matters because household size directly affects your subsidy eligibility because the number of people in your household matters as well as whose income that you're claiming. So that's all important. So let's say we have a child who lives with both parents part time after a divorce. Very common situation. The marketplace generally cares more about who is actually claiming the child on taxes than where the child physically sleeps most nights. So, if you have a divorce decree or a setup in which maybe you alternate who claims that child, that can change things from year to year on how your household is set up for marketplace eligibility. You could even have a situation where maybe an adult child lives at home, but they file their own taxes and support themselves financially. They may not be part of the parent's marketplace household and may need to file on their own. But these situations can get complicated pretty quickly. So it's important to make sure that you work with someone like an independent agent like us here at Acuhawk who can help walk you through the details of your situation and whether or not you include someone or don't in your household. Dependents. You usually need to actually claim them in order to actually. One of the next biggest mistakes people try One of the next biggest mistakes people make is trying to include dependents on the marketplace application that they're not actually planning to claim on taxes. So, like in that example we shared about the divorced parents, that can be a pretty common situation. And if you claim someone on the marketplace application, but on your tax return, you don't include them, then that's going to come out eventually when you compare and reconcile for your taxes. And in that case, that could have increased your household tax. And in that case, it could have increased your tax household size and qualified you for larger subsidies that you really shouldn't have been able to claim since you're not claiming that dependent at tax time. That can actually create issues later where you have to then repay the tax credits you already got as an advance. And honestly, sometimes it happens unintentionally. You know, and honestly, sometimes this happens intentionally, yes. But many times people are just confused, especially in blended families, shared custody situations, or situations where maybe grandparents or other family are helping raise children. But it's important to make sure that you communicate and get proper advice so that you can avoid costly mistakes when it comes to reconciling your taxes. And that's why it's really important to get it right the first time to make sure that your application matches the tax situation as accurately as possible. In the application, you are even saying that to the best of your knowledge, you're answering these correctly and that there can be penalties if you don't. Now, when it comes to marriage, there's another really important rule that can often surprise people. If you are legally married by the end of the calendar year, your marketplace subsidy eligibility usually requires that you file taxes jointly. Now, there are a couple limited exceptions involving situations like domestic abuse or spousal abandonment, but generally speaking, married filing separately can completely disqualify someone from receiving premium tax credits. So, if you and your spouse normally file separately, that's a big consideration that you'll want to make as to whether or not it's more advantageous to still continue to do so and pay full retail price for your health insurance, or if getting those tax credits may make it worth your while to file jointly in that case. So here's an example. Let's say a couple gets married in October and they both already had separate marketplace plans earlier in the year. If they don't update their application or understand how filing jointly affects eligibility, they may run into surprises at tax time because they may have actually gotten more tax credit throughout the year than they should have actually been eligible for. Even if you get married later in the year, it still counts you as married for the whole year when it comes to the tax credits. And sometimes people don't realize this until their tax preparer starts asking questions. So, when working with your local agent to plan out your healthcare coverage, it's important to let them know if you have any plans to get married or maybe even have a new dependent in your household before the end of the year. Now, let's talk about income estimates because honestly, this is where people can either save a lot of money or accidentally create some major tax headaches. The goal is generally not to intentionally underestimate your income just to get larger subsidies. Although that may seem like a good idea to help lower your monthly premiums, it's not advisable because, again, like we said, you are answering on the application that you are providing true information to the best of your knowledge. So the goal is to make the most accurate estimate you reasonably can with the information that you have at the time. Now, nobody expects you to have a crystal ball and know exactly what's going to happen. But again, it's just your best reasonable guess. So even if your situation now is, let's say you're employed full time and you're making a nice cushy salary, but you know midway through the year you plan to leave that job and open your own business where you don't expect to actually make any profit for the first year or two. Well, all of that can factor into your yearly income and should be considered when filing your application. Because, we understand that life changes and situations change. People change jobs, businesses grow, hours get cut sometimes, or maybe all of a sudden you're getting more overtime. People retire, families change, and a lot of that can be kind of unknown, or the deadlines are hard to estimate, or just how much of an income impact it has can be hard to estimate. but it's good to just get as close as you can. Now, what happens if you actually do underestimate your income? Well, if that happens and your household income ends up being significantly higher than what was on your application, you may have received more subsidy during the year than you actually qualified for. So when you file your taxes with your 1095A tax document that you get showing any kind of tax credits that you received and the months in which you received them for your marketplace plan, then you reconcile that when filing your taxes. Then some or even possibly all of the advanced premium tax credit might have to be paid back. So maybe someone estimated their income as 40,000 because business was slow early in the year when they first signed up. Then suddenly things improved and picked up and they got more clients. Maybe a spouse went back to work and now the household income is actually 65,000. Well, in that case, if the marketplace application was never updated, there's a chance that they actually received more subsidies than they should have throughout the year. And depending on the situation, repayment amounts can sometimes be significant. So in that case, let's say that when they did the application at the 40,000, let's say that they were getting 1,000 a month in subsidies for them and their spouse and a child. Well, then once they bump that income up to 65,000, let's say now that those subsidies should have only been 700. So that's a $300 difference. And we're just giving examples to keep the math simple. But in that $300 a month difference, assuming that they had coverage for the full year, the full 12 months, then they would actually have to pay back that $3,600, or that would be factored into their other tax situations. So if they were previously going to get a refund, not only could it take up that refund, but they could still potentially have to pay in, depending on what that amount ended up being. So it's really important to make sure that you're getting as close as possible to avoid situations like that. Then the other piece of that too is there are times where if your income goes exceptionally high, you could actually hit that income cliff. And in doing so, you might end up having to pay back all of your tax subsidies received, which obviously could be very substantial. So what happens if you actually overestimate your income on the application? So in that flip side, if you're so worried about owing money back that you actually estimate too high than what you actually make, then in that case, you might end up paying too much on your monthly premiums all year long and then actually end up getting owed the rest of that tax credit that you should have gotten when you go to file your taxes and reconcile. Sometimes people are trying too hard to avoid a tax surprise later that you accidentally create a cash flow problem throughout the year on your monthly income and charges that you have to pay. It really is a personal preference. If that's what makes you more comfortable and you can afford to do that, then that's understandable, as long as your estimate is still realistic. Obviously, you don't want to intentionally overinflate or underinflate your income. Now, next, you can update your income mid-year. So like we talked about, nobody's got a crystal ball. You don't know exactly what's going to happen. So you can actually use your marketplace application that you already submitted, during open enrollment or during your special enrollment period. You can update that and change certain things. One of the things that you can change throughout the rest of the year is your income. So if your income changes significantly, then updating your application can help, because then in that case, it will recalculate what subsidies you should be getting and help potentially mitigate how much you may have to pay back come tax time because you made the change mid-year. So things that can affect that might be like a new job, losing a job, increased overtime, Maybe your self-employment income changes, or maybe your expenses change when you're self-employed to the point where that makes a big impact on your bottom line. Could also include things like getting married, getting divorced, having a baby, or having changes to other dependents in your household. But updating the application sooner rather than waiting until tax season can sometimes help reduce the risk of owing so much money back. So it's important to make sure that you consider that and be as honest and upfront with your broker as possible so that we can help advise you and try to reduce the chance of having a big payback at tax time. And marketplace health insurance, just to wrap up here, marketplace health insurance can be a fantastic option for many families, especially when subsidies can help make coverage more affordable if you don't have access to affordable group coverage. But it works best when the application is accurate, updated when life changes happen, and built around the correct tax household information. Unfortunately, a lot of people don't realize how important those details are until they get to tax season. So, if you live in Nebraska or Iowa and you'd like help reviewing your marketplace options or even just understanding how your household situation may affect eligibility, we'd love to help. And if this video is helpful, make sure you like, and if this video was helpful, make sure you like, subscribe, and follow along because we'll continue creating educational videos that help simplify health insurance and other important insurance coverage topics.